Stop loss placement. Now, many traders don't realize the importance of your stop loss placement. This is a super important part of your trading strategy. Okay, a lot of traders think just because they have a stop loss, they're doing the right thing. Okay, but improper stop loss placement can be just as detrimental to a strategy as anything else. Okay, super important. Don't take it for granted. Always place your stop loss at a level where your setup is proven wrong. Okay, take that to heart. Always place your stop loss at a level where your setup is proven wrong. Maybe it's a larger stop. That's fine. Adjust your trade size. Okay, if it's too big of a stop and you can't adjust your trade size small enough, then don't trade. Don't take the trade. It's plain and simple. Okay, but what you cannot do is you cannot place your stop loss according to your own pain threshold. Okay, the market doesn't care about your pain threshold or your threshold for loss. The market doesn't care about that. It means nothing. Always protect your stop with key levels of support and resistance. You know, we're gonna show you how to place your stop with the divergence setup, and this also applies to when you're protecting your stop, like when you're managing your trade. And a lot of times, what I'll tell folks is with our objective divergence strategy that we're going to teach you, a lot of times once price moves in our favor a bit, and we test that support or resistance level again that qualified us for the divergence, we'll want to get the risk out of the trade. Well, I'll say don't always take all of the risk out of the trade. Okay, you don't have to get to free. I hear there's a lot of different things out here. You know, get to free and you know, whatever. But that's a mental thing. That's a mental thing. It's all about the psychology there. Okay, but what you want to do, even if you reduce the risk in that trade, you're doing what you need to do. So let's just say instead of taking your stop to break even, okay, which really doesn't mean anything to the market. There's no protected level there unless it is behind a protected level. Okay, but your break even doesn't mean anything to the market. Let's just say the market retraced 62% and created a swing. Well, put your stop above that swing. Who cares if there's 5 pips of risk left in the trade? Okay, who cares if the market comes back and stops you out for 0.1%? Okay, who cares? It's basically a break even. Remember, we're looking at the long term here, folks. Looking at the long term. If you do this, first of all, you're going to take less stops because the market's going to respect these levels before it's just going to respect your break even. So you're going to take less stop losses. You're going to hit more targets. All right, but the losses that you take, they're going to be really small. They're going to be very nominal losses, so your reward to risk ratio over the long term is going to be very good. You have to remember not to think of trading as individual trades, okay, but as a set of trades. And we'll talk a little bit more about that when we get into trade management. So anyway, I didn't mean to jump ahead there. Okay, but do not use the same number-based stop for all of your trades. Right, this is something I see in a lot of trading strategies, and it really, I don't understand it. Because, just for an example, you know, folks will look to enter into the market, and they'll say we're using a 20 pip stop and a 40 pip target. Because it's a 2-to-1 reward to risk ratio, we're good to go. Okay? Well, maybe if it's a average daily range of 50 pips, that works. Maybe a 20 pip stop works. Yeah, but what about the next day or the next week when the market's in 150 or 200 pip daily range? Because that 20 pip stop's not going to mean a whole lot in a market that has a 200 pip daily range. Folks, the market is dynamic. Your strategy has to be dynamic as well. It has to be able to change with the volatility of the market. Okay, the market is not static. And a static number value has absolutely no meaning to the market. The market cares about supply and demand. All right, that's where you want to protect your stops, supply and demand levels. And finally, think about this. If you do not place your stop where your setup is proven wrong, you're going to be tempted to enter into the market again because your setup has not been invalidated, potentially creating multiple losses for the same setup. For example, you enter into a divergence setup, and instead of putting your stop loss above the pattern that diverged, you put your stop loss above the 79% fib. The market retraces to the 62%. It starts to move in your direction. Then it moves back up and takes out your stop at that 79%, just above the 79%. It spikes through and then starts to move back in your direction. What are you going to do? What's your first thought going to be? Okay, we had a 79% retracement. Now it's moving in our direction. Let's enter back into the trade and put a stop above the swing. Okay, well, the market starts to move, and then it comes back up and takes out your stop again. This time it goes through the high, disqualifying the divergence. Okay, invalidating it. Now you've taken 2 stop losses on the same trade setup. If you're risking 1%, what you basically did was just took a 2% loss on the same trade setup. Okay, because you didn't put your stop loss where the pattern was invalidated. Okay, so just some things to keep in mind. Now, let's go ahead and look at how we're going to place our stop losses for our divergence trades. Okay, so this will be pretty simple actually. What we'll do is, this is, say we have this small divergence right here that's qualified. I'm not going to use the larger pattern here because it's only a small move. Oops, wrong drawing tool. So let's just say we have a smaller divergence right here that qualified right here. Okay, we had a nice little extension move in here, so we have a qualified divergence on this pullback. So what we want to do is we want to enter here, and we're going to use a limit order to enter into the market. I'm going to get rid of the 79% here for now. I'm going to have a limit order here to enter into the market. Our stop loss, okay, our stop loss needs to go above the high. Okay, the stop loss needs to go above the high of the divergence setup, of these swing points that diverged. Stop loss needs to be above that high. Okay, above the high of the pattern. Look at this market. Let me look at how far we retraced. Came up and went through the 79%. So if you had your stop on the other side of the 79%, you were stopped out right before the market moved down through all your targets. All right, let's see it over here again. Here we have our divergence. Okay, price moving higher, MACD swinging lower. Here's our qualification. Here we draw our fibs. Our stop loss goes above this high. Let me get rid of the other one because it goes all the way across. Our stop loss goes right here above the high. Okay, that's where the pattern is no longer valid. If the market trades above that high, it disqualifies this pattern. That's where the stop loss goes. Okay, so here's some more divergence. These aren't qualified setups here necessarily. I'm just going to do this just to show this. All right, here's the divergence. I just want to show a lot of examples of how to place your stop. Here's a divergence. If you're trading this, the stop loss needs to go above this high. Okay, if you're trading this divergence here, price moving lower, right here, MACD swinging higher. Let me move this over so I can actually draw on this. There we go. Sometimes these little buttons get in my way. Price moving lower, MACD swinging higher. If you're trading this, okay, the stop loss needs to go below this low. Okay, that's where the pattern is invalidated. Okay, so you can see for divergence is pretty simple. This is pretty simple stuff here. All right, because for every divergence that we're going to trade, and no matter how you're entering into the trade, no matter what entry method you're using, okay, you're going to put a stop. Your stop's going to be above the high or the low of the divergence pattern. Okay, that's it. No exceptions. No exceptions. Okay, the same thing. If you're trading the patterns, now there's divergence here, but if you're trading the patterns, the doubles and the triples that we were talking about earlier, how the market moves, the same thing. The same thing. If you're trading this for a double, if you're looking at this as the initial leg, the pullback, and you're looking for a double, okay, your stop loss needs to go below this low. Pretty simple stuff when you're pattern trading, when you're divergence trading. Okay, you need to put your stop above or below where the pattern is no longer valid. Plain and simple. Okay, so I think that's pretty straightforward there. And now let's go ahead and talk about our next segment, which will be trade targets.